Good morning and welcome to Saxo Bank's morning call. This is Tuesday, the 4th of December. What an eventful 24 hours we had. We had a monster session yesterday, risk on, equities up more than 2.5% at one point, and we're sort of retreating a little bit here overnight in Asia. But before we talk markets, Ole, we probably have to do an advertisement here. We go to the slides. We are announcing our outrageous predictions for 2019, and our chief economist, Steen Jacobsen, is already live on CNBC, where he talked through our 10 outrageous predictions. And not to go through all of them, but maybe one of the most outrageous one is that Apple secures funding. That's obviously playing with the word from on Twitter when Elon Musk, the founder and CEO of Tesla, said he had secured funding for taking Tesla private. We're saying that there are synergies here, and that Apple, in an outrageous bid, will buy Tesla. But we also have another outrageous prediction, and that's really tied to the front cover, Ole. And
yeah, Trump says you're fired, and the question is obviously with what's the events over the past couple of days, maybe that's not going to be necessary, because we are obviously seeing some expectations for rates coming down next year. So maybe it's just saving it, but remains to be seen. But it could be an interesting one.
But he has been extremely critical. Yeah, I mean, I think it was a recent interview where he said that I don't see any positive, or he almost said I regret appointing him as a.
And they obviously throw the whole the situation about their independence into disarray. So that could be. It is outrageous, but the ramification of if it happens is obviously the reason why we do these outrageous predictions. That just to provoke some thinking.
And if someone wanted to fire a Fed chairman, it is likely going to be Trump. Yeah, it would be very outrageous in a historic setting.
The link to all this will be, you can find it on Twitter, but also on home.saxo. It's now on the front page there on our research area.
All right, but we don't go. We have a lot on our plate today, so we won't go through more of them. But go to the front page to see it. But we had a central bank decision from the RBA overnight. They kept the cash rate steady, and as you can see here on the chart, we had the Aussie dollar stronger overnight. It was coupled with also a stronger Chinese currencies. Sentiment seems to be bolstering a little bit in China, and we'll talk a little bit later about the confusion. Ole, you found a very interesting commentary on how the Chinese perceive this so-called deal that was struck at the G20 meeting. Yep. But as you can see here, we're pushing towards some of the highest levels since August. This is what we're going to talk about today. There's a lot of confusing signs in the market, because a stronger Aussie dollar and a stronger Chinese currency is risk on, but at the same time we have equities declining. And if you look at this chart here, it's the US dollar index, and it's falling across the board, and that's also a risk on indicator. But we're seeing confusing signs, because you brought this slide with us here, and that's quite telling. It's the gold and it's the yield curve that we're now seeing being inverted.
Yeah, gold is really receiving a double tailwind here from the strength of the renminbi, as Peter mentioned, and also the bond strength. We now got 10-year bond yields back below 3. It's trading around 2.95 this morning. The yield curves are continuing to flatten. The 2.5s went inverted overnight, and the 2.10 is now down to something like 13 basis points, really fast approaching the inversion level as well. So it doesn't really indicate that we're seeing much strength in the US economy, and this is really playing into the hands of gold investors. We're once again challenging this key area just around the 1240 area. The market remains short, so if we do break, there could be some additional short covering come in to take it higher. But I think
you might argue whether the signal we're getting from the US is it the US that is potentially weakening here. Versus a China that is strengthening, and maybe that's sort of also what was the outcome of the G20, that maybe the China has the better hand here now versus the US.
Well, we have this scenario, and actually we can just give you an example of this on this chart here, because I put in the soybean chart, because that really has been a key indicator of the flow and ebb of this trade war. trade negotiations. And it was reported that the Chinese new official statement did not include the mention of the 90-day deadline, and it did not mention either the requirement of the nation to start buying U.S. farm goods immediately. So you can see soybeans is back down to the $9 bushel level this morning. So really a great deal of confusion about what was actually agreed, and for now the market is probably starting to get a little bit concerned already.
Yeah, it seems so. But before we go into the equities, you also have an interesting slide here on oil, because
this is probably what potentially could save Powell is the fact that we have seen this collapse in oil price, and that is going to reduce the inflation expectations. As you can see, these are the year-on-year changes in crude oil and CPI, and there seems to be quite a good correlation there. And this has also over the last months led to the future expectations for rate hikes to be reduced by a full hike. You can see this is the 30-day federal funds future, and this is a change over the last month. So you can see when we go out to in a year's time, there's basically a full rate hike being taken out of the market. So question is if we are going to see even more being taken out.
But if we go back to that slide, it's interesting to see if you go 1 year out, the blue line, we are at 2.7. If that's the level in the FENFOX rate, definitely you would have an inverted yield curve unless the long end of the yield curve rises. So and that can only rise, I think, if we have higher growth or higher inflation. So we need a stronger oil price or some other push into the price level, because otherwise I don't think the Fed will be able to deliver on these expectations.
No, exactly. So
very interesting. Then also equities. As I said in the beginning, had a monster session yesterday. At one point, we were up 2.5% in global equities. Obviously, most bit in emerging markets and the cyclical equity markets across the board. China, you had Chinese equities traded through ADRs in the US that had a very good session yesterday. But we sort of came back during the session, and if we look at this chart here, it's the Nasdaq 100 index futures, the largest 100 stocks in the Nasdaq exchange. This technically looks very ugly. So we had we met very strong resistance levels in yesterday's session, and we now looks like the market is trying to close that gap in the futures that were established on the opening on yesterday's Monday here. And what we probably see here is potentially a little bit more weakness if this confusion of what's going on takes hold in the market.
And we also have to remember December tends to be a very equity-friendly month. So if we're starting off on this kind of behavior, then we still got long months ahead of us then.
Exactly, and I argued actually yesterday my equity monthly that I'm leaning towards a positive December here. I still think on balance the G20 event and Powell's speech leads into a positive month for equities, but be aware of the headline risk. If the confusion grows and we have Trump beginning to argue with the stance from China on what really took place under that G20 meeting, then we could be in for a very volatile month again. Then yesterday, as you can see here on the slides, we introduced new equity market and industry models in that equity monthly, as I did. It was sort of an attempt here to try to be more transparent and have a systematic approach to sort of guide and give inspiration to watch markets and what industries are overbought and oversold. And interestingly enough, if you look at the market, that's the table to the left-hand side. The markets that are overweighted in terms of weighing valuation and momentum, we had the very much the cyclical markets tied to China, so Japan, Sweden, Brazil, Australia, also Hong Kong should be overweighted according to this model. If you look at the industry, that's potentially quite interesting for you. All the energy is the second highest, driven by very low valuation and actually a decent momentum relative to everything else. And then media and entertainment, I highlighted that in the equity monthly. That's the bellwether of Alphabet, Facebook, Tencent, etc. So, just a final brief comment here. What's interesting on the industry model is that there is no clear signal that all the cyclicals should be overweight or underweight. It's mixed across the board, and that's probably what makes this market a little bit more confusing. And then we're going to talk about oil, right?
Yes.
The OPEC.
Yes. We just to finish off, we saw the big jump in crude oil yesterday, and that has continued to a certain extent today. But also yesterday was interesting because the market is now once again raising putting their hopes on OPEC reacting on Thursday when they have their meeting that they will cut production. Bloomberg had their monthly survey out for November yesterday, and these charts basically speaks a very, very clear language. You can clearly see that who's been driving this oversupply that has been established over the past few months. Saudi Arabia and UAE combined is almost 1.5 million barrel increase year to date. OPEC is up. Half of that increase has been offset by others, because as you can see, OPEC yesterday is up 750, and Iran is currently down more than 700,000 barrels yesterday. The reason why the market is still struggling is because the year-to-date change in Iran at this stage market would have expected that to be well above 1 million barrel loss, but due to the waivers, it isn't, and that's why the Saudi Arabia's dramatic increase in production has basically left the market oversupplied. So there will be a lot of pressure on Saudi Arabia and UAE and Kuwait on Thursday to be the ones stepping up to the plate and cut production. And in order to do that, they obviously need Russia on board as well. So it's going to be an interesting few days here, but the market is most certainly at this stage looking for a cut.
But for the global consumer, this is very good. Low energy prices, and especially as we talked about it extensively over the past couple of months, especially emerging markets, because of the weakening currency, stronger dollar, and stronger oil price had been really hit hard by these high energy prices. But now it seems like maybe we're coming back to a more normal level. Yeah, and that's really one of the. I think that's one of the key things that there will be focused on over the coming weeks. That the slowing in demand growth of 2019, that slowdown may be halted here by the slump we've seen, because emerging markets, they account for close to 90% of global growth in oil demand, and this was most certainly would have helped. But actually, this leads us into the next slide, because later today at 1:30 CET, I will hold my monthly commodity update webinar. This is the last one of the year. And obviously a lot of themes, we've touched base on some of them here, but a lot of themes currently going on in the space due to the impact coming from, especially from Trump, China, Saudi Arabia, Russia, and so on. So tune in if you can. I mentioned the link there as well, where you can sign up. Interesting times. Okay, let's end this by going through the macro calendar for today. It's not a heavy calendar today. It's very thin. Potentially maybe the Carney speech in the UK Parliament at 09:15. These are GMT times. It could potentially rock sterling. So watch out for any headlines coming out of that speech. We know that the Bank of England is in a very peculiar situation with the potential hard Brexit coming. There's a lot of turmoil in UK politics, and then it's followed up 15 minutes later with UK construction PMI. We know construction in the UK is really not collapsing, but is weakening quite significantly. Also, house prices are very fragile at the moment, especially in London. And the UK politics has also basically meant that that's also been taken into our outrageous predictions. One about a certain Corbyn, but obviously you can look it up and see for yourself. Exactly. But if we go back into the calendar, as John mentioned yesterday, look for that Friday. Average hourly earnings. I think that's going to be the most important print of this week, because it feeds directly into inflation and interest rate expectations. And with interest rates coming down in the US, I think this number will have massive amount of attention, more than usual. So I think there's a lot of build up till Friday. And with that concludes it. So we'll be back tomorrow at the same time and place. Thank you.